the Metals Minute. Today is Wednesday, March 27th, 2024. Well, we have a little bit of a breather this week for the metals. Gold's down just a fraction on the 1 week basis. Silver, palladium, and platinum are down 2, 3, and 4%. But by the time you see this, it looked like the trend was reversing when I was finishing up the editing, and gold very likely may be higher again by the time you see this video. It looks like it anyway. On a 1 year basis, the monetary metals continuing to put points on the board. We have silver up 8, gold up 13% on a 1 year basis. The industrial metals, platinum and palladium, are both lower on a 1 year basis. So all the details are in the write-up. Today I want to talk about the subject, questions to ask yourself before investing in gold. You know, it's good to ask ourselves some questions, and one of the questions that comes to mind right now is, do you want to invest in something that goes up not only as the dollar rises, which gold has been doing this year, or do you want to invest in something that also rises even more when the dollar goes down? Everybody's talking about lowering of interest rates at some point in 2024. Gold has been showing a lot of strength even as the dollar has been rising this year. And it will likely do even better as the dollar begins to come down later on. So that's a good short-term reason why gold has a good opportunity right now. Now, another question that's very important to ask is, do we want our investments to purchase in the future what the money would purchase right now? In other words, do we want our purchasing power to be able to keep up with the cost of living? If the answer is no, that doesn't matter, then you may not want to consider gold. If the answer is yes, I want to be able to purchase at least as much of stuff as I can purchase now. And that's an obvious answer, and if that's your answer, then you should definitely consider gold. You know, I did a lot of research a few years back on comparing gold to other places where people invest money. And I work in our personal business, our family business. I work in all aspects of financial planning using all different types of products, and there's an appropriate place for everything. But what I looked at was comparing gold to the performance of stocks and bonds. And over time, stocks are often touted as a way to beat inflation. Well, that doesn't always work out even over long periods of time. And we went back to the early 1970s and looked at the performance of the major stock indexes as compared to gold. And what we saw, and I'll put a link to that article in the write-up for today's video, but what we saw was the market did make a lot of percent over a long period of time. I mean, like, I don't remember off the top of my head, 2,900%, somewhere in there, over that period of time. The problem was the value of the dollar decreased by more than what the stock market increased. So when you cashed out at the end, not only had you paid taxes and had reporting every year that you owned those stocks, especially if you owned them in the form of mutual funds or all the ways that people typically own stock investments today, you had a lot of taxes to pay along the way, reporting, and just fees and all kinds of things like that. But then at the end, even without all that, you had less purchasing power than when you started. When we compared that to gold, gold exceeded the amount that the dollar dropped. So gold went up by more than the value of the dollar dropping. So you actually still had, and matter of fact, you had a little bit more purchasing power than when you first invested the gold, comparing apples to apples. Another reason, a question to ask yourself is, do you want to improve your portfolio or do you want to make it less effective? If your answer is, I want to improve my overall investment results, then gold is definitely something you should consider. Other studies have shown that a typical 60-40 portfolio that only includes stocks and bonds over time does not perform as well as a portfolio that's, say, 55, 35, and then 10 in gold. And what they have seen is that over time, that portfolio that includes gold is less volatile and it performs better in the long run. A higher overall return is achieved with less roller coaster than if you don't have gold. And some people may say, well, what good is 10%? Or how does that make a difference? Well, in times when stocks and bonds are under severe stress, that small amount of gold that you're holding in your portfolio really performs well with outsized gains, and that can counteract the downward pressure on the stocks and bonds. And it's amazing what a small allocation of gold can do to help lessen the volatility and the anxiety involved in investing in other assets. So this is a couple of reasons. There's lots more we'll talk about in the future. We appreciate your time today. We look forward to sharing more of those ideas with you next week. Thanks a lot for tuning in. Have a great day.